Hi there, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of September 30th, 2025. Happy fall, and thanks for tuning in. This past quarter, the U.S. economy has started to cool, with tariffs, government cutbacks, and lower immigration weighing on growth. The good news is that strong tax refunds expected in early 2026 should provide a short-term boost. Job growth has slowed, but fewer new workers are keeping unemployment from rising too quickly. Wages are holding steady, balanced between the tight labor market and broader economic concerns. Inflation has been calm lately, though we expect it to rise as tariffs filter through and consumer spending picks up. The Fed has begun easing rates, but they're moving cautiously since inflation is still above target. In the markets, large U.S. tech stocks continue to dominate, though valuations look stretched. Bonds are offering fair yields, and international equities remain attractive, helped by a weaker U.S. dollar. As always, I'll use JP Morgan's Guide to the Markets to help connect the dots. Feel free to pause anytime if you'd like to take a closer look at the charts. All right, let's get started. The combined impact of higher tariffs, government spending cuts, and lower immigration has started to weigh on the U.S. economy. Most of those effects will likely show up later this year. If we look beyond short-term swings in imports and inventories, real final sales, the part of GDP that reflects underlying demand, are expected to improve a bit from 1.9% annualized growth in the first half of the year to about 2.5% in the third quarter. After that, though, growth could slow sharply to below 0.5% by year-end. Looking ahead, the passage of the One Big Beautiful Bill Act, or OBBBA, should provide a boost early in 2026 as large income tax refunds hit households. That temporary jolt of spending power could lift growth in the first half of next year, but as the refund effect fades, the drag from tariffs and weaker immigration may once again slow momentum later in 2026. This slide highlights how the U.S. job market is cooling after a very strong stretch. Job openings have dropped from a record 12 million in 2022 to about 7.2 million as of August 2025, showing that businesses are hiring more cautiously. Even so, layoffs remain near historic lows because companies still don't want to lose the workers they already have. The middle chart tracks the number of people quitting their jobs. Quits are gradually returning to pre-pandemic levels, a sign that workers feel a bit less confident about finding better opportunities. The bottom chart shows layoffs, which remain relatively low, suggesting employers are holding on to staff in the tight labor market. Altogether, these trends point to a slower but still healthy job market. Fewer openings and quits suggest the balance between employers and workers is normalizing, while low layoffs show the economy isn't sliding into recession. It's a step toward a more sustainable pace after several years of exceptionally strong labor demand. The impact of tariffs on inflation is beginning to show, with year-over-year CPI inflation rising to 2.9% in August. Tariff-related price pressures are likely to grow in the months ahead as retailers mark up new inventories. By the fourth quarter, inflation could reach about 3.7% year-over-year on the Consumer Price Index and roughly 3.4% on the Personal Consumption Expenditures Deflator, the Federal Reserve's preferred measure. These elevated inflation levels may persist into early 2026, supported by stronger consumer spending as larger income tax refunds reach households. Inflation could peak around the second quarter of 2026 before easing. As economic growth cools again in the second half of 2026, inflation is projected to gradually move back toward the Fed's 2% target. This slide looks at how expensive U.S. stocks appear compared with their earnings. The most common gauge is the price-to-earnings ratio, P/E.
simply the price of a company's stock divided by the earnings it generates per share. When investors are willing to pay more dollars for each dollar of company profit, the PE rises. That can reflect optimism about future growth, but it also means expectations are high and returns may be more limited if earnings disappoint. Today, the S&P 500 trades around 23 times forward earnings versus a long-term average of about 17. That tells us stocks are priced above their historical norm, helped by strong profits and enthusiasm for new technologies such as AI. Valuations like these don't automatically signal trouble, but they do suggest investors should expect moderate returns and that earnings growth will need to keep supporting current prices. This chart shows how the biggest U.S. companies change over time. Each column represents the 10 largest firms in the S&P 500 at the start of each decade, with the total size of those top 10 companies shown at the top. Back in 1985, the top 10 were worth about $250 billion combined. Today, they exceed $19 trillion, nearly 40% of the entire index. What stands out is how different the names are from decade to decade. Energy and industrial giants once dominated. Now, technology and digital platform companies like Apple, Microsoft, and NVIDIA lead the list. This reflects how innovation drives market leadership and how quickly industries evolve. The takeaway for investors is that leadership changes, sometimes dramatically. Staying diversified rather than concentrating heavily in the current winners helps capture new growth opportunities as markets shift over time. This chart shows how often individual stocks experience pullbacks even in good years. The green bars represent the number of S&P 500 stocks that dropped 5% or more at some point during the year, while the gray bars show how many ended the year down that much. On average, about 3/4 of all stocks see at least one 5% decline each year, even when the overall index finishes positive. In 2025, 372 companies have already experienced that kind of drop. The message here is that short-term volatility is normal, not a sign that something's wrong. Pullbacks are part of healthy market movement and often present opportunities for long-term investors to rebalance, harvest tax losses, or reinvest at lower prices without losing sight of their broader goals. The U.S. dollar has fallen sharply since the start of the year. Part of that decline reflects how overvalued the dollar was coming into the year, along with America's persistent trade deficits. Another factor may be growing concern, both domestically and abroad, about heavy investor exposure to U.S. assets and uncertainty surrounding the new administration's policies. A key long-term driver of the dollar has been the higher interest rates offered on U.S. bonds compared with other developed markets. As the Federal Reserve cuts rates more aggressively than other central banks in the months ahead, that interest rate advantage is expected to narrow. Combined with a still large trade deficit, these trends point to the potential for further weakness in the dollar. So far in 2025, international stocks have significantly outperformed U.S. markets. Local currency gains have been further boosted by the impact of a weaker dollar. Given this strong performance, some investors may wonder if they have missed the opportunity to increase international exposure. However, there are several reasons that may not be the case. First, even after this year's rally, non-U.S. stocks still trade at much lower valuations than U.S. stocks. Second, the dollar remains expensive relative to U.S. trade fundamentals, leaving room for additional long-term declines. Third, after years of U.S. market dominance, many portfolios are still underallocated to international equities compared to what would be considered a balanced long-term mix. This slide shows how the performance of international developed stocks, the purple area, often moves in long cycles that correspond with the strength of the US dollar. When the dollar weakens, foreign markets tend to outperform the US. When the dollar strengthens, US stocks usually lead. After a long period of dollar strength that began in 2008, JP Morgan believes we may now be entering a new extended phase of dollar decline. That shift is being driven by slower US growth, narrowing interest rate gaps between the US and other economies, and expectations that the Federal Reserve will cut rates more aggressively than its peers. A softer dollar can be a tailwind for international investors because overseas earnings translate into more dollars, and valuations abroad are generally lower. International developed markets have already gained about 25% this year, roughly 10 percentage points ahead of U.S. stocks, marking the strongest relative performance since 2009. The broader message, these long currency and performance cycles turn slowly, and diversification beyond U.S. markets remains an important way to capture opportunities as global leadership shifts. A renewed round of Fed rate cuts and early signs of a softer labor market have helped long-term interest rates drift lower in recent months, even as inflation has edged higher. From this point, long-term rates are likely to stay within a range. The downward pull from slower economic growth should be balanced by upward pressure from increased Treasury borrowing, following the passage of the OBBBA and from tariff-related inflation. For bond investors, there isn't a strong case for taking big positions in either duration or credit. Even if the economy weakens, any bond rally could be limited by heavier federal borrowing and persistent inflation. In the near term, the economy appears likely to avoid recession, helping to justify today's relatively tight credit spreads. Maintaining roughly normal bond allocation seems sensible in this environment. Historically, when the Bloomberg Aggregate Bond Index has yielded around 4.3%, 5-year annualized returns have been close to the same level. Assuming inflation eases late next year, those yields and potential returns look reasonable. A slower U.S. economy is likely to mean slower job growth. Average monthly payroll gains could fall below 50,000 for the rest of 2025 before picking up slightly in 2026. Even so, the unemployment rate may not rise much, largely because immigration has dropped sharply. Illegal immigration has fallen close to zero, deportations have increased, and new immigrant visa issuances have declined. Overall, net immigration may fall to fewer than 250,000 people per year, down from more than 1 million annually before the pandemic. With fewer new workers entering the labor force, unemployment is projected to reach about 4.5% by late 2025 and hold there into early 2026. Wage growth is expected to remain steady as recession concerns offset pressure from tight labor markets during wage negotiations. This slide shows how different asset classes perform each year and why diversification matters. So far, in 2025, nearly all major markets have posted strong gains. A sample diversified portfolio, the gray box, is up 13.5% year to date. U.S. stocks are up 15%, while international markets have done even better, developed up nearly 27% and emerging up 30%, the biggest international lead since 2009. Bonds have also contributed with both high yield and core fixed income positive. The main takeaway is that it pays to stay invested and diversified. Unlike the past few years when a handful of tech giants led the market, this year's gains are broad-based across regions and sectors, reminding investors that balance, not concentration, drives steadier results over time. There you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's video. As always, please feel free to reach out to me to review this and more.